Hey, this is Jim Musgrave, and I appreciate you watching my Q4 2021 market update. And in the picture right there, you see three grocery baskets and some coins that gradually get bigger. Again, that represents inflation, and that's been the big story this year. So let's get right down to it. So let's start with the S&P 500. Again, things are still looking pretty positive. Again, we've been up 93% since March 2020. And we've had a little bit of a pullback in September, about 4.7%, but we think that's a temporary pullback and also an opportunity to buy the dip. And you can see the S&P right here. Again, it's been just a super smooth sail this year so far. Again, we basically touched the 100-day moving average, and we're starting to kind of rally, at least as of here in mid-October. And again, we should see certainly a positive year. Again, the S&P's up about 19% year to date, which is doing fantastic. Again, bonds. Again, this is I feel like it's just a broken record. It's like Groundhog Day. Again, we keep on talking about the interest rates kind of going up and bringing some pressure to bonds, and then things kind of go in an opposite direction. So we can kind of see that this year, that interest rates have been going up and down and really kind of pulling bonds up and down. And right now, you can see in sort of end of September to where we are right now, interest rates start to go up again, which puts some more downward pressure on bonds. So this is the big story that I'm going to talk a little bit more about in just a minute. And again, I've showed the slide multiple times this year in my market updates. Again, things are being really influenced by the 10-year Treasury. And you can see things have been fluctuating between 1.48 and about 1.6 in the last 2 weeks. And this is just kind of where we are. And just kind of, let this sink in again. I feel like I'm a broken record saying the same thing over and over and over again. Again, when you're looking at what treasuries are doing and how low those yields are, and then you look at how high inflation is right now, you guys need to connect the dots about making sure that you don't have too much cash on hand. I'm still talking to a lot of people who've got large amounts of cash money markets kind of sitting on the sidelines because either they don't know what to do with it or they're scared that the market's going to crash or whatever. I understand, but again, you're paying a huge opportunity cost by having that money in cash if you're not going to use that in the next 3 to 6 months. So again, if you're concerned about things and you want some ideas on how to invest your portfolio to minimize risk but still kind of get a better return than what you're doing in cash, certainly give me a call. But again, the Treasury bond interest rates and inflation, that's the big story right now. Student of the market. So again, we had talked about that things are going pretty well with the S&P 500, and again, the September we finally broke that 7-month winning streak. So September is typically a month that has negative returns, and certainly it didn't disappoint this year. And you can see on the right side of the screen, we've had 7-month streaks in the past, and all of them have actually ended up in positive territory a year later. And in the lower right-hand corner of your screen, you can see that the average length of the streak is 7 months, and a year later, the market's up about 12%. So again, it's very, very normal for these pullbacks to happen, and we're still pretty bullish. Again, the 8th worst start of the year ever for bonds. And, again, I just kind of talked about that in the bond, slide just a few slides ago. But what's interesting on the right-hand side is that, in more cases than not, in the next 3 months, bonds should actually be in positive territory. On average, bonds have been up 2.3%. In the first 9 months, they've been down about 2%. So again, you have to kind of hang in there and just understand that the market's going to go through its cycles, and that's just kind of how it is at this point. So let's kind of look at the growth versus value trade. Again, growth has really outperformed value for many years, and but now we're kind of seeing that the value is really starting to kind of pick up some steam a little bit. We see in the left side of your screen that again, Q1 through Q3 of 2020, again, there's the large cap, a lot of tech was doing very, very well at that point, and again, value started to kind of when the arm wrestling match in Q4, Q1 of this year, then the COVID variant kind of kicked in, and again, so you can kind of see when things are a little shaky, the growth tends to outperform. But if you look on the right side of your screen, you're going to see that when you see these wild swings, either up or down, you're going to see that the opposite will typically happen. So if you go back to February 2000, growth dramatically outperformed value, and then remember that was that was the technology, or the tech wreck in the late 1990s that bursted. And as the market started to recover, you saw the value stocks really outperform. And you go back to 2020, just last year, you can see that growth has outperformed, and now value is starting to kind of rally. So again, we've owned value sectors in our portfolio for quite some time, and we've certainly benefited from that. But we do feel that the value should have a run and moving forward. Again, long-term core bond returns. This is a really nice chart because it kind of shows a 10-year rolling return for the core bond index. And you can see where we are in September 2021 is that this is the first time in 53 years where the average 10-year return for bonds will be 3% or lower. That's a long time. And, again, this is a trend that we feel is going to continue. And really what it forces you to do is to kind of rethink your portfolio and to make sure that the fixed income part of your portfolio is doing what it's supposed to do, because this is what's acting as a drag on a balanced portfolio right here. And that kind of leads me into active versus passive bond funds in 2021. And again, there's different points of view on this. Some people feel that active funds always do better, and some feel that passive funds do better. But it's really not an either or scenario. It's really you've got to have a combination of both. And we actually have a combination of both in our portfolios, where when interest rates go up, you can see the vast majority of bond managers that really outperform the indexes. But when rates go down, bond funds, sort of flat indexes also tend to outperform. So I think it's really understanding the trends and making sure that your fixed income portfolio is allocated properly with sort of a mix of both active and passive investments. And one of the things that we've been doing is working alternatives into our portfolio for the last quarter or so. And what we've been doing is introducing a broad commodities basket. You can see, year to date, it's up almost 28%. So, carving a little bit out of the fixed income portfolio to put some in commodities has been a trade that has really paid off this year. And so you can see on the right-hand side, there's different types of alternative investments, but obviously the commodities have performed the best. And you can see over almost $24 billion of new money has flowed into alternatives just this year. Pretty impressive. And again, going back to the inflation story, you can see the broad-based housing, food, medical care. You can see these huge increases, and also how they weigh in the index. Obviously, housing has the largest weighting in terms of the headline inflation. And you can see housing as a broad category is up about 3.5%. And you can kind of go across the board. And obviously, education is always a concern for families with college and private school. So that continues to go up, as well as other areas. I've personally seen the inflation seen in my household with food, and that's been a big driving factor. So again, the inflation is a story that's going to continue, but we don't think it's going to continue more than maybe another few quarters. I mean, as basically as the supply chain starts to kind of work itself out, we should see inflation come down a little bit. And again, that's one of the big reasons for inflation is that you go out to the West Coast, you have I don't know how many tankers, these huge freight ships that are just waiting to dock to have their goods and services to be unloaded. So I know that the Biden administration is, having the port of, I think, Long Beach or LA or whatever it is to have 24 hours so we can actually get those goods and services out and get those tankers and those cargo ships to unload their goods and services to get the products to the manufacturers so they can actually meet the demand. So that's, so that will eventually kind of work itself out, and we see that inflation will slowly drop, but it's going to take some time for that to happen. Okay, so kind of wrapping things up here. I mean, overall, we're very, very bullish. Currently, we've got all green arrows, in contrast to where we were in 2020. Obviously, a huge contrast to where we were in 2009, 2008, the last bear market recession. So things are very, very positive. And finally, again, the recession dashboard overall is in positive expansion. Again, there could be some tailwinds with the inflation will continue to be a tailwind. If the variant virus, continues to go, and people continue to have that, and that could also be a headwind. But also rising corporate taxes we're not sure where the tax laws are going to land with the Biden administration. We'll see how that all works out. But again, overall, as I mentioned this before, we feel that these sell-offs are a buying opportunity due to multiple positive market factors. So again, the call to action is that, again, talk to me about our tax efficient portfolios. And again, my big concern right now, in addition to interest rates and inflation, is capital gains tax and other taxes. So I'm doing everything I can for my clients to minimize taxes, especially in the capital gains area. And again, I got some upcoming Social Security workshops. I'm still working on my tax storm webinar, and I certainly will let you guys know when we got a date for that. But we're making really good progress on that. So again, if you want to schedule a call, there's the link to my calendar, and you can certainly give my office a ring as well. So there's my phone number. So listen, hopefully this was helpful to you, and we're overall positive. So stay tuned. We will catch up with you in mid-January for our Q1 market update. In the meantime, listen, you guys stay safe and healthy, and enjoy your holidays, and we'll catch up with you in January. All right, take care.